assume somebody's loan with a low interest rate, and especially as the loan amount gets bigger, it gets more and more powerful. Just the numbers can get to be pretty staggering. So, just from a real basic level, as a seller or as a homeowner, whose loan is assumable. The tough part is probably 85-90% of the loans out there are not assumable. And what do I mean by that is the only loans that are assumable, and they have to be assumable because it's hard coded into the promissory notes. All FHA and VA loans are assumable. They have to be assumable. The servicer of the loan can't say no, we don't like doing them. If they take on and they service FHA and VA loans, they are assumable. They have to be assumable. The tough part is, probably 80 to 85% of the loans that are out there are conventional loans. Those are not assumable. No form or fashion. They won't do it, can't do it. They're not assumable loan products. And then kind of the ones, that are kind of on the fringes, like if a credit union did like a portfolio loan or a jumbo loan that's not a government-backed loan, more than likely those are not assumable. And the reason I say that is, doing the assumption process, they're big time money losers and time, quote unquote time wasters to the services out there. The only reason they do it is because they have to do it. So if they don't have to do it, they're more than likely they're not going to do it. They're going to want to get a 2.5% loan off their books before they spend time and effort, passing it along to a new person that's out there. So, if you're listing appointment, talking to your buyer, one of the questions to ask, do you have FHA? Do you have VA? Okay, well then maybe this is something we at least explore and look at.
Why is that though? The FHA and VA are assumable but not conventional?
Because the government decided a long time ago that they are. And that's the best reason I can give is that since the beginning of time they decided these things should be assumable, and they've just never changed it, and they always are, and they've just continued on that the promissory notes have always had that in there. So if you do have a seller that says, wow, I do have an FHA or I do have a VA loan, maybe this is something that can be something that helps me sell my house. First thing they want to do is have the seller reach out to their servicer, because that's who's going to handle it. So even though a person may come to you with a Wells Fargo pre-qual form, they rip that thing up. If they want to do the assumption, they're going to go through whoever the homeowner writes their monthly payment to. That's who's going to handle it. And so what they want to reach out and just figure out, what's your process. Typically they're going to have some sort of a boilerplate packet where they're going to kind of give you the basics on it. But you want to find out from the servicer what the process is, and then especially what their turn times are. You can imagine at a bureaucratic big bank and a money losing process like an assumption that we've already decided is, you're not going to get the best customer service. Most of the time, I tell people, unless the servicer says something different, assume that it could be as much as a 2 to 3 month process for no good reason other than you're wasting their time. And they're just, because I handle come on in, you didn't miss much. I help at VIP Mortgage. We service some of our own loans, and so me and another guy, we kind of handle the assumptions. So we get them done in 30 days, just because when I do it, my goal is to impress the agents, get it done and hopefully get some business out of it. So we get them done in 30 days because they're doing an assumption. We're qualifying the buyer just like we are in a regular loan. It's nothing more than we're running their credit, we're collecting their income and asset docs, and we're figuring out, do you qualify for this loan, just like we would if somebody was buying a house and doing an FHA loan. But I think we're the exception rather than the rule, because I've helped out a buyer get a second mortgage to do an assumption, and we had to work with Lakeview. They don't do a whole lot of upfront loans, but they buy a lot of loans and they service a lot of loans, and it took 60 days. And we were worried about whether we were going to close on time, because not just because Lakeview, they were just, hey, we'll get to this in 30 days. They got the initial done in 30 days, and they kind of dragged their feet through the entire process, and you can never really talk to anybody. So it's as a seller, you need to know, I need to move in, I need to do a simultaneous close, and I need to move on this day. Maybe not a good candidate for an assumption, or a buyer who needs to be in. But as long as the seller and the buyer are both understanding that you're really at the whim especially if it's a big bank, you're going to be kind of at the whim, and you just got to kind of be, okay, we're both getting something out of this. Hopefully, so hopefully we know we have to kind of deal with our runaround, but at least try to get a feel for it at the start. And usually, with how long it even takes to get that initial information, will kind of give you a good idea of how long it's going to take going forward. If it takes you a week to get an answer back on what do I do, that could be a precursor to how long it might take during the process. And then keep in mind too, as you talk to your homeowners or your sellers, the sweet spot is obviously people who have had the house when interest rates are low. I mean, that's the goal of all this, is you're taking over the low rate. So just some real rough numbers. Interest rates, we kind of went above the 5% mark in roughly April of 2022, and then we went above 6% in roughly October of 2022. So if you do some farming, maybe Jill can kind of tell you, like your sweet spot would be, I want to find homeowners that have an FHA and a VA loan that have owned their house prior to these dates. And even if they bought their house in 2010, they probably, and they still own it, they probably have a super low rate, because they probably refinanced sometime in 20 or 21 at a super low rate as well. So, but somebody who bought mid to late October 22nd, 2022 or later, probably not a great candidate, because now as we've kind of gone back down, into the mid to low sixes, really what you want your sweet spot to be is a lot of those homeowners or sellers who have loans like more than, ones, twos, and threes. It's kind of what you're going for. Any questions so far?
And we can pull those lists in zip codes, north, south, east, west street boundaries, cities get a little bit big, but
okay.
we can narrow down.
And you can search by loan programs.
Yeah, we can search by FHA, VA, or originated.
Okay. Yeah. And that's awesome, because a lot of those homeowners, they kind of think, well, what does it benefit me? Why would I do this? And we'll kind of get into why in some of the slides where it really can be something to help you sell.
We can also skip trace for phone and emails too.
Okay. And so the benefits to the buyer, it's pretty self-explanatory. I called my lender, and my rate starts with a 6. If I'm going to buy a home, I'm probably going to have a rate that starts in the 2s or 3s, and it can be just a huge savings on monthly payments. As far as the closing costs go, the closing costs are on the lower side. FHA lets the lender charge $1,950. That's literally the total profit they make on the loan. So by the time they put the time and effort into it, it is a money loser. We're still going to have normal title fees. You're still going to do, if you're a buyer or seller, there's still going to be an AAR purchase contract where you're going to pick a title company in the middle, and they're going to do the same title search and everything like that, because even though it's just moving the note over, the lender wants to make sure everything's still the same on titles when they took it over. And then your buyer's still going to have, they're going to set up their, just like if they're buying a new house, they have to do a new insurance policy on the house, so they're going to pay their first year homeowner's insurance up front. But there's not going to be, any loan origination fees or discount points or anything like that. There's also no appraisal fee, so the buyer is going to pay for that as well. That's for FHA. For VA, the VA says there's going to be a 0.5% VA funding fee. So the funding fee is like the tack on that VA always does for VA loans. For assumptions, they say it's a 0.5% funding fee. Plus, they let the servicer charge $600 to recoup, expenses, and then once again, normal title fees plus first year of insurance. So that's that. As far as the qualifications go, if you're buying a house and you want to assume somebody's loan, it's pretty similar qualifications to if you're doing a normal FHA VA loan. So ideally like a 620 or a higher credit score. The biggest thing is the buyer needs to be buying it as a primary residence. So unfortunately, investors, it's going to be a no-go. Snowbirds buying it as a vacation home, that's going to be a no-go. It needs to be your primary residence. The buyer needs to be buying it as a primary residence. And the only difference is, like normally, on a normal FHA VA loan, when I qualify somebody, I take their application, I run their credit, and I run it through like the automated approval engine. The automated approval engine lets me go to like maybe a 55% debt ratio. When we do the assumptions, it's what's called a manual underwrite, which the only difference is a manual underwrite just has a little bit more stricter on the debt to income ratio. For the most part, we can't get above like 47, 48%. So it's still pretty accommodating. It's just slightly lower. A couple of them that we've worked on, people have come to us and they've had an FHA pre-qual form in hand, but they were going all the way up to 56% on their debt ratio. And we said, hey, I know you could buy a house for this amount at FHA, but you can't assume it because it's just a little bit stricter. But moral of the story is, if somebody's approved for a conventional loan, even these normal FHA, VA, I'd say they're going to qualify if they have a pre-qual form for a conventional loan. They're going to be able to qualify with even the manual underwrite on an FHA or VA loan. Any questions so far? Yes.
I know this is probably a really stupid question, but for a VA loan, to assume that you have to be a veteran?
You don't.
Oh.
No, you don't. And we'll talk about that a little more on the next slide. So, do not need to be a veteran. Do not need to be a first-time buyer or anything like that. It's just purely, I'm going to move into this as my primary residence. And we'll talk a little bit about the ramifications of the VA part of it, the entitlement. That's just one of the things to keep in mind for it.
So you said for these, there's no appraisal?
No appraisal required.
Okay. So when you assume the VA loan or an FHA loan, and the seller says, yeah, we got a assumable loan, okay, who do you talk to assume that loan? Because
so the first thing, if your seller says, hey, we think we want to, we think we want to put this on the market with, we think we want to put this on the market as an assumable loan. The seller wants to reach out to their servicer, whoever they write their monthly payment to. That's who's going to handle it, because that servicer, all they're doing is taking my homeowner's name off of it and putting my buyer's name on the promissory note. So it's all handled through the servicer. Whoever they write their 800 number on their monthly mortgage statement, that's who they reach out to, and they just say, hey, I know I have an FHA or VA loan, Lakeview Servicing, Wells Fargo Servicing. I want to sell my house and let somebody assume it. What's the process? And they're probably going to give you some sort of a packet and saying, hey, you go under contract, have the buyer send us the stuff. It's going to be like a loan application the buyer fills out.
so the seller's got to do that?
The seller's got to do that because the seller is the one who initiates it. If I'm going to sell my house and I have a VA loan,
but isn't that going to be easily screwed up? I mean, the seller's going to go like, maybe they don't know what the heck's going on in the first place.
well, all the seller needs to know is I have an FHA or VA loan and I think I can maybe sell my house for more money because I'm going to offer an assumable loan. And then at that point, all the seller's doing is trying to get top dollar, just like they would any other top dollar, knowing whatever they get their contract accepted for, it's a done deal because there's no appraisal that's going to kill it. Like if I think my fair market value,
but I'm just worried about the process of the servicer screwing up. Is what I'm worried about. Because who at the servicer cares?
And I think you walked in like a minute late. This is a money losing proposition for the servicer. They have, if it's an FHA or VA, they have to do it. It's just because it's a money loser, you're not going to be their top priority. So like I said at the top, it can take a couple of months to do these. So you need to have a seller that's understanding of that and also a buyer that's understanding of that you're kind of at their whim. I help for the assumptions we do at VIP Mortgage, I handle it, or me and another guy handle it. We have an underwriter underwrite it. We get them done in 30 days, but I usually get oh my gosh, at the end of it, I can't believe you got that done so quickly.
So you help the seller?
Help the seller and the buyer for that matter.
You work with the servicer.
Right, so the seller is a VIP Mortgage customer currently, so we always start out with them is just they say, I want to sell my house and have somebody assume it, and I just say, okay, if you find a buyer, here's my online loan application. They need to hit the apply now button and fill out their stuff, and then we're going to run their credit. We're going to collect their pay stubs and W-2s, and then we as the servicer handle that loan just like we would if somebody was buying a house on the open market. And then so I collect all that upfront paperwork. We have an underwriter manual underwrite it. They approve it. We do a closing disclosure. We do loan docs, everything like that.
So if I have a buyer that wants to buy, and the sellers say, yeah, I'll do an assumable thing, then we can have you do it.
If I'm the servicer.
No, but I mean you work with the servicer. Is that what you're saying?
The only time I work with the only service, so VIP, if you write a check to VIP Mortgage as a homeowner, that's the only time you're going to deal with me. If you write your check to Wells Fargo, you're going to deal with Wells Fargo. If you write your check every month to Chase, you're going to deal with Chase. It's whoever the homeowner's loan with it, because think about it, all you're doing is that exact loan, we're just taking one name off and putting that other name on. The only person that has the authority to do that is the person who owns that note currently.
you don't have a choice in the lender that you use in this case.
Right. If you want to, if you got pre-approved with XYZ lender and you say I want to use them, that's fine. You can use them. You're not going to be assuming the loan because the loan's going to go through XYZ, not who the homeowner writes their check to every month.
Hey Ryan,
Yeah.
so if you're writing an offer on a property, because you said that it could be a multi-month process, do you can't go in with a standard 30-day close. What do you recommend, or what do you see most commonly? Like, would you talk to the listing agent and say, hey, listen, I know that this could be a lengthy process. We can put in 60 days and then revisit that if it's going slower, or like, what do you?
Yeah, so when you talk to the servicer up front, a lot of times they may just tell you only do a 60-day close, or like I tell them you can do a 30-day close, that's fine. Hopefully you can get some sort of feedback from the servicer at the start.
Gotcha.
The one that I worked on where I was more on the buyer side where we did a second mortgage to help it out. On that one they did a 60 days or sooner type close date.
Okay.
So it's kind of figure out if the seller has any input and then figure it out from there, but it's good. It would be good to say 60 days or less.
Okay. And I did have one more question. I've seen in some listings and stuff like that where it says like qualify and no qualify assumable loans. Do you know what I'm talking about with that?
I've never heard of a no qualify assumable loan.
Yeah.
Because FHA and VA specifically say you do have to qualify.
Sure.
So the only ones that we have, we don't have any loans on our books that would be no qualify. So the only way it would be a no qualify assumable loan is if it's whoever the current lender is. It can't be the FHA and VA. It would be XYZ lender lent their own money and now they've decided they're going to make it assumable, and they might have a no qualify assumable loan.
Okay.
And it could even be like a seller carryback
I was
type
gonna
of
say,
thing. I mean,
like,
it would be strange to me that a bank or a financial institution would do that. I have a sneaking feeling that it's a hard money loan or a seller carry or something
Sure,
like
okay.
that, where they just say, hey, sign up and make the monthly payments and I'll do it for you.
Okay.
Any other questions while we catch up? Okay, good. So we've already figured out, hey, if I'm a buyer, I get a screaming low interest rate. As a seller, what are the benefits to me? Understand that what you're giving the buyer is a huge financial benefit. If I'm giving you a huge financial benefit and kind of going through maybe a lengthier process, I want top dollar for my loan, my home. I mean, if my fair market value is $500, I want $520. I'd love $550. I mean, when we go through the numbers, a lot of it, when you figure out how much of a premium can I get or demand, a lot of it depends on how big of a nut am I giving to the buyer that's taking it over, and that'll kind of tell me how much bang for the buck can I get for this loan that I'm giving you. Understand whatever you negotiate on your contract. Like I said, there's no appraisal required. So if your house is worth $500 and you can get the buyer to pay $520, $550, it's done. There is no appraisal. It just doesn't happen. That's FHA, VA says, don't put it in the file. We don't want to see it. We don't care about it. Two different things as far as the seller. Okay, well, what's the impact to me after I close? There's a release of liabilities form that both sides sign and notarize. That basically the FHA one says the seller is fully released from this loan and from all liability. So it's going to have, just like if you sold your house and it got paid off, it's going to fall off your credit report. And if the buyer who buys your home doesn't make payments or forecloses, it's not going to come back on you as the seller. That's for FHA. For VA, it's a little bit different in that the seller is still released from all liability, meaning it's going to come off their credit report. It doesn't matter if it gets foreclosed or short sale; they can't come after you for anything monetarily, but their VA entitlement sticks with the loan. And so what that means is, when a veteran calls me up, let's just say, the first time they buy their house, they say, Ryan, I want to buy the house for $500,000 and I want to do a zero down VA loan. I say, heck yeah, no problem at all. That's what VA is all about. If somebody calls me up and says, I currently own a house and I used a VA loan on it and there's currently a VA loan on it, and that I want to buy a second house and I want to use my VA loan, I say you can do that, but part of your entitlement is already tied to this current house. The same thing happens if you let somebody assume your VA loan. It's the same formula that we use. And so Can I get it to quit? So the easiest way to explain this part of it, what does that mean when I lose my entitlement? Right now, the cutoff in Maricopa County for 2024, a jumbo loan cutoff is $766,000. So if somebody calls me up and says, Ryan, I want to buy a house I want to borrow more than 766K, I say need to do a jumbo loan, so that number changes every year. The way that the VA works is you can do a 100% VA loan, and the amount that you can do it for is tied to a bucket of money. Every year that bucket of money is based on what the jumbo cutoff for the year is. So somebody calls me up today, I say you have a 100% bucket of money up to 766K. Let's just say the veteran that's going to sell their house and let somebody assume it, let's say their original VA loan amount was 266K. So if they sell their house and the new buyer assumes the loan, now my bucket of money for that veteran, the next time he wants to use if that veteran wants to go buy a house and use his VA loan, as long as he bought a house for 500K or less, he could do a 100% VA loan. And so that's kind of where it is. Or if that veteran says, and so this applies the same formula is I let somebody assume my loan, or I move out of my house and I let somebody rent it out. We use the same formula because the entitlement sticks with it. The entitlement's still alive. Let's just say this homeowner says, Ryan, that's great that I can do a 500K, 100% VA loan. I want to buy a house for 600K. And I'd say you can still do that. Keep in mind, the VA only guarantees 100%. They only let me do 100% of 500K. And the reason that we can do that is because the VA guarantee is 25%. So the VA guarantee is what it's for. Now they want to buy a house at 600. Well, the VA isn't going to guarantee that extra 100,000. So I'm going to say, Mr. Buyer, Mr. VA buyer, you need to keep me at 25% of the whole loan. We're 100K over your bucket of money, you need to do a $25,000 down payment. Mm-hmm. So, moral of the story is, because now my entire loan is guaranteed at 25%, we can do it. So moral of the story is, like a lot of veterans say, oh, I can never use my VA loan again. Well, you can probably use it again. You definitely can use it again, it just matters how much is your 100%er and how big of a down payment. But keep in mind, if I'm selling my house with a 266K loan that I got 2, 3, 4 years ago or 10 years ago, you're probably selling it for 500K. All of a sudden doing a 25K down payment's no big deal. Or even the step forward on that, usually if you got a couple $100,000, you're probably going to choose to do a conventional loan anyways. And you're probably past the days of doing your 100% VA loans. It's probably not going to be a negative thing going forward. I don't want to tell the seller that or the homeowner that, but more than likely, once you have a big bucket of money, once you have 20% down or more, conventional typically makes more sense anyways. And so it's, okay, I don't have it, but if I was never going to use it anyways, is it really that big of a deal? So that's kind of like, what the ins and outs of, what are the, so it's important that the veteran understands that, but once they kind of research it and look at it, they usually say it's not really that big a deal. And as this thing turns on, the other thing too, you had asked about, hey, do I need to be a veteran to assume a VA loan? You don't need to be a veteran, but if it was a veteran that was assuming it, we could set it up where the new veteran's entitlement would take over and the seller's entitlement would be wiped clean at that point. And really there's no way we have to do it. Really, that's buyer and seller just tell us, how do you want to do this? Do you want to leave their entitlement on there, or do you want to use your entitlement? You guys negotiate it out, just tell us how you want to handle that.
If you are successful in assuming one of these types of loans, let's say 2, 3, 4, 5 years goes down the road, you decide, oh, I want to buy another property. Is there like some sort of statute where you can never do this assumable loan thing again? You have to sell the current one, or what's the time frame in which you could do that?
So you could, if you did a VA or FHA assumption today, just like any other loan you do, when you buy a house as a primary residence, your intention is to live there for at least 12 months. Mm-hmm. So really, once you've lived there 12 months later, you can move out, rent it, leave this loan on there, just like any other loan, and you could go buy another house on the open market, you could go and do another assumption at that point.
Okay.
No questions asked.
And because these are both government-backed types of loans, can you do a FHA and then say do a VA a few, years later or whatever? And, or, like, are they completely separate or are they looked at as the same? So as far as like, you've assumed the FHA and let's say that 9 months goes by and you want to do a VA, something like that. Like, you've got to look at it in 12 months. That's the statute, pretty
Yeah.
much. Okay.
I mean, and that's not even a written, that's really just kind of a generally accepted, if you buy a house as a primary residence, your intention is to live there 12 months. If you got transferred, if you got
Yeah.
divorced, if your spouse died, there's reasons where you can get around that. We have you write a letter of explanation. Hey,
Okay.
why are you doing 2 primaries in 12 months? If it makes sense, it's up to an underwriter to say, yeah, that makes sense. You got transferred to Kentucky. That's why you're buying another one and renting this one out.
Okay.
So if a veteran assumes a VA loan,
Mm-hmm.
is that funding fee still the 0.5 or is it that veteran's funding?
No, it's still the 0.5 at that point.
So he doesn't have to.
Right. And so we're almost to the bottom of this one. Benefits to the buyer. The other cool thing about when you assume a loan, since you're literally just taking over the loan and changing the names out, you take over the remaining years. So if it's a 30-year fixed and they've been paying on it for 5 years, you've only got 25 years left. You've already kind of moved down the amortization schedule by 5 years. So that's another cool thing as a buyer too.
So the loan servicer, okay, will directly be in contact with the title company to do the things that they do?
Yeah, absolutely. And that's why when you do a purchase contract on these, it's a normal AAR purchase contract. There has to be a title company, there's title insurance, escrow fee, and we just tell the title company, hey, just so you know, there's a buyer and the seller, you charge both your normal fees. Keep in mind the loan we're doing is an assumption. And usually they'll kind of like, oh, okay, let's make sure that, typically they're gonna make sure that the escrow officer is familiar with it.
Right.
It's not really that much difference because really the loan everything to the title company is the same. They're transferring title. It's really the lender package they get. If the title company actually looked at it real closely, they say, oh wow, it's 26 years left on this loan. It's a little bit different in that format, but still they're just tasked to notarize the loan documents like they would on any other loan docs that came over.
The only role that the seller has to do with the mortgage servicer is just contact them and get the details or whatever for the loan, and then give that to the potential buyer.
Right.
And then the buyer now deals with that servicer.
Right.
So, okay.
All the seller's doing is just raising their hand, telling the servicer, I'm going to put my house on the market. I'm going to offer assumption. What should I do? And when I do these, I just say, hey, if a buyer wants to pre-qualify, here's my apply now. And just understand that when they hit apply now, you're going to check a box that says we're going to run your credit, we're going to check you out and everything like that. So I usually just say, just like if you're selling your house, before they do the apply now, like, hey, do you have a pre-qual form already? Okay, if you're already pre-qualified, then and you want to assume it, you need to do this apply now because we're not going to work with it's whoever the servicer is, and they do the apply now, and then I say, yep, they're a qualified buyer. See if you guys can come to terms on it. If you come to terms, let me know again, and we'll kind of take steps 2, 3, and 4.
Okay. So now I think this is what I've been missing. So the buyer has no lender. The buyer is assuming the loan
Right.
from the servicer.
Right.
So there is no lender.
There is no there is no lender. Whether the buyer came in with a lender or not, forget about that lender.
It's done.
It's done. It's the service. It's like
There we go. That's the
Yeah.
final.
Okay. And so here's kind of like, okay, the bang for the buck, the great news for the buyer, but then also the great news for the seller, because like how much of a huge benefit am I giving the buyer? It all comes down to what my current interest rate is and how big the loan amount is. Obviously, the bigger loan amount that you're handing over, the bigger the benefit. So as a comparison, just to kind of put it like frame of reference. My homeowner has a $300,000 loan. calls the servicer, says, I think I want to let somebody assume this. I want to sell my house for $500. I'm going to let them assume the $300,000 loan. What kind of benefit am I giving the buyer? Well, if the buyer, any buyer on the street, let's just say they called their lender last week and they were quoted a rate of 6.75%. So let's just say that buyer is a conventional buyer. They were going to do a $300,000 loan amount at 6.75%. The principal and interest payment was going to be $1,946. If they said, well, let's rip up that 6.75 pre-qual form and I'm going to work with the servicer to assume this. If they took over the VA loan, and this is at $300,000 at 3.5% interest rate, which is probably going to be lower that, but you can tell they're already right there. It's $500 a month. You know, that's a freaking big deal, you know, for anybody. Or if it's FHA, it's still nice, but it's not as much, because keep in mind, FHA, all FHA loans have mortgage insurance on them. And if you assume it, you keep the mortgage insurance. So even if I buy it for $500 and I do a $300K loan, I do a $200K loan amount. If I do FHA, I'm still assuming the principal and interest plus PMI. So it's still a good benefit. It's just not as big of a benefit to FHA, because it's still going to have that MI that carries over on it. But in that case, it's still, you know, you're still pushing $300 a month savings. The other way to look at it is, okay, well, what if I'm this buyer and I say, well, I don't like this house, but I like that payment. If I was going to keep my conventional loan at 6.75% and I was still going to borrow $300K and I wanted one of these payments, I would have to borrow $80,000 less or $45,000 less to have the equivalent payment. So, like, as a seller, when I say, if I have a VA loan and I'm at 3.5%, $300,000, how much of a benefit am I giving to this buyer? I'm really giving them like an $80,000 benefit on payment dollars. You know, so I should be able to demand. I think I should be able to demand more than the neighbor next door that's not giving them a Super Bowl loan.
So this could be a good strategy for homes that are sitting on the market for a long time right now.
Absolutely.
Assuming that they bought the loan, or they got the house, you know.
Assuming that they have the low rate, assuming it's FHA VA.
Right.
I mean, that would be a great way. Or even like, you know, you have the crappiest house in the neighborhood because it needs to be remodeled. You know, let somebody assume it, and that's a way to, you know, honestly, you've got something that nobody else has. It's kind of what it is.
Right.
For FHA loans, do they have the MI for the life of the loan?
Yes. Well, for the most part, yes, unless you do 10% down out of the gate, and then it's only there for 11 years. But I don't know, I've probably done 5 FHA loans in my life in 20 years that do 10% down.
So if you assume the loan, let's say that you assume the loan is an FHA loan, can you pay down the principal or something like that to where there's now equity in the house
Nope.
to remove the MI?
Nope.
No.
Nope. Because and that's just a weird thing, like, if I were buying a house at $500 and getting a $300K FHA loan today, I would do $200K down and my new FHA loan would have PMI on it. If I assume the loan and I do $200K down, you still have PMI on it. It's just the FHA rules, it's hard coded in there, this loan shall have MI on it for the life of the loan. So really at that, so really I say, if you think about it, your 3.5% down FHA loan, the equivalent is, it's probably like, the reality of it is, it's kind of like 4.4%, because we've got that PMI on top of it.
Right.
Versus a VA, it's really just a flat out 3.5%. So like, quote unquote, the APR of an FHA is higher because they always have that PMI into it. So that's why, as a seller, the other thing, if I'm going to let somebody assume my loan, I would just say, cross out your name and just put the mortgage statement in there, just so people can say, here's what you're taking over, or at least put it in the MLS comments. Hey, it's an FHA loan. My buyer's monthly payment is, you can however you want to say it, but $1,940, however you want to put it, but just say, here's the payment, and just specify if it includes taxes and insurance, or the easy thing is just put the mortgage statement in there, because it's going to be very similar, because principal and interest aren't going to change, taxes aren't going to change. The buyer's going to get a new homeowner's insurance policy, so it's going to be slightly different, but it kind of gives them a sanity check for what am I getting if I make an offer on this house with the assumable loan on there. And then where it gets really, really powerful, if you start to get up into bigger loan amounts, which most of these are going to be VA loans because FHA has cutoffs and most people don't. There's a lot of big VA loans out there. I mean, $1 million houses with 500K VA loans on it. I mean, like, if you look at this example, same thing. If we were going to do a 500K loan and we had a conventional at 6.75, that's 32.43 on principal and interest. A A 500K loan at 2.5% is like $2,075. I mean, you're talking almost $1,200 different. I mean, and that's just, 2.5%, a lot of these are 2 or even 1.75. I mean, it can be astronomical. At this point, if it was a big FHA loan, you're pushing $800 a month. The bigger the loan, the bigger the benefit is, and also the bigger the spread, interest rate on the assumption versus what it currently is, can get really, really powerful. When you start thinking about this scenario, a 500K loan, if I wanted a payment of $2,075, I would have to borrow $180,000 less to get that same payment. Or even on FHA, if I wanted $2,478, I have to borrow, still even $115,000 less. I mean, it's a huge, huge benefit. And so this example, huge, huge benefit. Also, it kind of spells out what's the biggest challenge about assuming a loan. What you're assuming is that loan amount. You need to bridge the gap between the sales price and the loan amount. So if you have one of these rates on here, you've had your house long enough to see the huge uptick in appreciation, you're gonna need a big chunk of money. So if you're working with buyers, it would be a big down payment buyer, ideally, or the only other way around that is, and I've done one of these and it closed. At VIP Mortgage, we have a broker option. We have a second mortgage that we can put on top of the assumption, but that still only goes to 90%. So like in this case of, let's just say the buyer called me up and I'm trying to make easy math for myself. Let's just say we'll say it was a $300,000 loan amount that was the assumption, and it was a 500K sales price. Your buyer would have to have at least 10% down, so 50K for the down payment, plus your closing cost and prepaids that we talked about, maybe $6,000-8,000. But then we could do a second mortgage on top of that to get you up to 90%. So by 90%, I mean it would be a $300,000 first mortgage. We would do a new 150K second mortgage that would get you up to 90%, and then the buyer would need to do their own 10% out of their own funds to get to the rest of it. And then at that point, keep in mind that home equity line of credit, it is going to be at a higher interest rate. Those are variable rates based on prime. So like right now, prime is at 8.5. So a HELOC at prime plus 1.5, it's a 10% effective rate. So it works out good for, as the second mortgage gets bigger and bigger and bigger, it's still beneficial, but just that spread of how much you save can go down. But I still think, it's still going to be, honestly, if they do the math, if you have a savvy enough buyer, even if I'm taking on a 2.5 or a 3.5% down loan, even if I have that second mortgage at a higher rate, the numbers are still going to look pretty darn appealing. Not as appealing as if I had my own full down payment, but still pretty darn appealing at that point. And there's not very, we can broker out to 6 different second mortgage companies. Only one of them will go behind an assumption because it's a pain in the butt for them, because just, you're dealing with, like when we did ours, we were dealing with Lakeview, which was a pain in the butt. It took a long time, and it took 60 days to close. So most second mortgages don't like to do them. Like I said, we have one, and I do it even though it's a pain in the butt, hoping that, hey, I'm going to earn business from this agent going forward. Or the one that I did, it was actually, the seller was a good agent of mine, and she's like, hey Ryan, I kind of told her the ins and outs, and I said, hey Jenny, for you, I'll do it because you're a good agent, or for one of you guys who took my class, hopefully if I'm willing to work for peanuts and work real hard, hopefully that earns some business later too. So it is an option, but the bare minimum barrier for entry is at least 10% down.
And I think I missed the first part of that question. This could be, if we have a buyer who is getting down payment assistance, they could assume, but it would have to come out as a second.
Well,
or they would have to.
No, not down payment assistance. So
Okay.
the perfect scenario would be the buyer who was looking at 500K houses. Let's just use this one for easy math. The perfect buyer for this would be the buyer who was looking at a 500K house and was already ready to put a 200K down payment, and then says, that's awesome. I'll just assume it at 300K instead of doing a 30-year fixed conventional 300K. Mm-hmm. The tougher one would be the borrower that you're working with now that says, I want to buy a $500,000 house and I've only got a 10% down payment because that's just all I have in my bank, and I don't have rich parents or whatever. And they say, but I've heard about this awesome assumption thing. Well, you either need to find somebody with a 500 sales price and a 450 assumable loan, probably doesn't exist. Mm-hmm. You say at that point, well, are there any other options? The only other options are you take the 300K and then you borrow 150K on a new second mortgage. Mm-hmm. That gets you up to 450K of a loan. Now my buyer comes in with the 50K plus the closing cost and prepayments.
Okay.
And so like as, typically, a good listing agent, if it's an assumable loan, they have it in big capital letters in their MLS Plano. You should be able to search for, do a search for assumable loans. And then if you do have a listing or you're a listing agent, I would recommend, like I said, definitely give the breakout of the payment, what the payment that you're offering, because that's really the selling tool. And if you guys have one of these, I can kind of help you work up some numbers too if you want to get real fancy with it. You can say that, say I don't know, ask your broker what you can say $800 a month compared to what you do on your regular loan, however you want to do it. Or I like it when they just put the mortgage statement in there, because then it's just like, hey, that's your name's going to be on the top of this mortgage statement. That's what you're taking over. And so that's kind of, that's really getting to the end of the, really the power of it is the numbers. The rest of it, how do I find them? If you've been a realtor for a while, any of your old closed buyer files, see if they have an FHA, VA, and just let them know. If you ever want to sell, or if you want to sell next month, you have a huge, we can get top dollar from your home because you have a loan that is assumable, and then advertise on social media. And then Jill at Chicago Title, she's already said, an awesome way to do it if you want to find listings, have Jill set up a farm kit and search it by zip code, by your neighborhood, FHA VA loans that closed before, that have owned their house since, before mid to early 2022. Any other questions? Okay, okay.
Has there been any banks that you've seen that don't move at the speed of molasses? I know it's a loss, it's a lost cause for them, they're not making money, but have you seen banks that are possibly a little bit easier to work with than others?
Probably the smaller the bank, the quicker they move. So I think like credit unions or like that. The slowest, I promise you, are going to be BofA, Wells, Chase. They do everything slow.
Yeah.
Money losing profit, they're going to be the slower on this. But the smaller the bank, probably the better chance you have of them just saying, let's just get it done. It's not like they're hard, but just getting it done and having the wherewithal to say, let's just do it, not wait.
Perfect.
Any other questions? All right, you guys are assumption experts. And if you guys have questions, or like I said, if you want me, if you have a seller that's thinking about it, rather than trying, it takes me 10, 15 minutes to put together some numbers for you. I'd be more than happy to do it. Or if you have a buyer that wants to talk about it too. What's that?
Make sure you guys all sign.
Oh yeah, make sure, if you don't mind, make sure that everybody did the sign-in sheet up front.
Thank you.
Thank you guys. Yeah, you're right. And I got my cards, and then Jill will have her cards in back too if you want to reach out to them.
So the best case is a VA loan
VA would be awesome.
that just did a refi,
Yeah.
and he's got zero equity.
Maybe they did a cash out refi in 2021 and took out a huge loan.
Can you do that with VA?
Yeah, you can do cash out refis. So there are a decent amount of very big VA loans out there that are good as gold. And a lot of them, I did a lot of VA loans at 1.75%.